When it comes to the world of investing, most people don't know where to start. Fortunately, great investors of the past and present can provide us with guidance. There is a famous quote by Benjamin Franklin which says, "An investment in knowledge can pay the best interest." When it comes to investing, nothing will pay off more than educating yourself. And that's exactly what we are going to do in today's video. As quoted by Dave Ramsey, financial peace isn't the acquisition of stuff. It's learning to live on less than you make. So you can give money back to the community and have money to invest. You can't win until you do this. With a reported wealth of $210 million, Dave Ramsey is an evangelical Christian and he is a successful financial educator and a real estate investor. He continues to grow his real estate empire by running the popular Dave Ramsey Show in the US. By being modest in your spending, you can ensure you will have enough for retirement and can give back to the community as well. Having said that, let me welcome you all to this video where I'm going to talk about the basics of investments and will share some insightful investment tips with you all. The points that I'm going to cover in this video are the basics of investments for beginners, what are fixed income investments and market-linked investments, what are the different options available for investment, where I'm going to cover 10 different types of investment options like bonds, stocks, mutual funds, FDs, exchange traded funds, gold, real estate, digital currency, and others like PPF and NPS. How to choose an investment or the right asset classes that best suits your requirements, where we will look at 8 important aspects that one must consider before investing in an asset. We will also compare various investment options and understand how they work, and the pros and cons of different types of investments as well. We will understand the Pareto Principle, which is the 80-20 rule. We'll understand the magic of compounding, and we will talk about balancing stocks and bonds and how to pick the stocks, where I will explain the 5 most important aspects, which are dividends, PE ratio, historical return, beta, and earning per share. So make sure you watch this video to the end in order to get a good understanding of all the different types of investment options that are available and to decide which ones suits you the best. But before we begin, I would request you all to please subscribe to my YouTube channel, Financial Fitness with CA Ashima Abel Yunus. It's totally free. You can just log in on YouTube with your email ID and click on the subscribe and like icon and share it with your family and friends. You can also share it in the WhatsApp groups in your phone as well. I hope you would like the contents of this video. If you do, then please add a comment on this video on YouTube, as if you do that and subscribe to my channel and like the video, it would encourage me to create more such videos to bring some more financial planning tips for achieving financial success. I will just take a quick pause for 5 seconds so you all can take time to click on the subscribe icon, like icon, and also click on the bell icon that you will find below my video. Please do that while I wait for 5 seconds. Okay, so now I will quickly introduce myself for my new viewers. Here I am, CA Ashima, a professionally qualified chartered accountant and a certified auditor. I have worked as a partner and a director with one of the top 25 leading CA firms in India, which has also been a member firm of one of the big fours. After working in India for a period of about 10 years, I moved to Sweden and have also worked as a senior financial consultant with a multinational. I have also catered to the clients in Sweden, Finland, Norway, Denmark, and the UK, and I have also worked as a freelance financial consultant. Well, as a Christian, I am always trying to look to God's Word in order to learn about how I should be living my life when it comes to my personal life, my finances, and everything in between. While we are to put our hope in God, that doesn't mean that we shouldn't be planning ahead for the future, saving, investing, and diversifying our holdings. In fact, we are told that these are all wise things to do. Saving up for a rainy day, putting your money to work, and multiplying it is a wise thing to do, as is also written in one of the Proverbs that says, "The plans of the diligent lead to profit as surely as haste leads to poverty." Having said that, let's begin with the basics of investment. What is an investment? Investment is a process of acquiring an asset with an aim to generate money from it. There are different types of investments available in the market. Not all investments suit all investors. Each of these has varying levels of risks. Hence, investors have to choose those types of investments that best suit their financial plan and goals. Generating income from an asset can be through regular income or through appreciation of the asset. Appreciation is the increase in the value of the asset over time. When an asset is purchased for the purpose of investment, the investor will not consume it. Instead, the investor will use it to generate wealth from it. The main purpose of investing is to acquire an asset right now and to sell it at a higher price at a future date. Now let's understand different investment options. There are various types of investments available in the market. The most popular ones are stocks or equities, real estates, mutual funds, fixed deposits, gold, government bonds, corporate bonds, ETFs, which are exchange traded funds, cryptocurrencies, PPF and NPS are few other well-known investment options. Each of these differ based on the returns they offer, level of risk, tenure, taxation, and whether the returns are guaranteed or market linked. Investors need to understand their goals, set an investment horizon, contemplate on their understanding of risk, understand the taxation of each of the investment products before choosing an investment option. They should never stick to just one investment option and should invest in multiple investment vehicles. Having a diversified portfolio will help them spread their investment across multiple assets. Moreover, having an investment portfolio with more than one type of investment will help boost portfolio returns. It is essential to have a balanced asset allocation for earning optimal returns. Asset allocation varies with age, investment goals, and risk tolerance of the investor. Now, let's understand how investments work. Investing is a way to get money to work for you. When one invests in stocks and bonds or a piece of land, they aim to generate money from it in the form of dividend, interest, or capital appreciation. Hence, investing is spending money today on something that will help generate income in the future. Investing is different from saving. In saving, one is setting aside money for future use. Whereas in investing, one is purchasing an asset with an intent to generate growth from it in the future. Saving will not give returns that will help beat inflation. In contrast, returns from investing, if done right, are higher than the rate of inflation. Saving comes with no risk, while investing has certain risks involved. Saving suits for short-term or immediate goals, whereas investing is best for medium-term and long-term goals such as children's education, marriage, and retirement planning. Investing involves risk of losing the investment money. Since investing is about generating future income, there is always a risk. For example, investing in shares of a company can look like a viable option today as the company performs well. However, in the future, there might be chances of the company going bankrupt. Hence, investing always comes with an element of risk. So, investors need to understand this before choosing to invest in any of the investment options. With a wide range of investment options available in the market, it is often quite difficult to shortlist the right one. Hence, one can either hire a financial advisor to help with investment planning, or one can also do a good research by educating and learning about various aspects of investing. Though a financial advisor charges a fee for their services, their expertise might help one achieve financial goals. Let's understand the different types of investments. There are different types of investments in the market, and I have bifurcated them into three main categories. The first one is fixed income investments, the second is market linked investments, and the third one are all other remaining investments. Let's look at what are the fixed income investments. These investments give guaranteed returns in the form of interest. These are low-risk investments. Fixed income broadly refers to those type of investment security that pay investors fixed interest or dividend payments until their maturity date. At maturity, investors are repaid the principal amount they had invested. Government and corporate bonds are the most common types of fixed income products. There are other different types of fixed income securities like bonds, fixed deposits, debt mutual funds, senior citizen savings schemes, etc. Debt mutual funds are fixed income mutual fund schemes which invest in debt and money market instruments like commercial papers, debentures, treasury bills known as T-bills, and government securities. These instruments pay interest during the investment tenure and pay the principal amount upon maturity. The second type of investments are market-linked investments. Market-linked investments are those investments that do not guarantee returns and their returns are dependent on market movements. These are considered high-risk investments. However, the returns from these investments are also high when the market rallies. Mutual funds are the best way to invest money in a disciplined manner. It invests in market-linked financial instruments such as equity, debt, stocks, and money market funds. The returns are generated as per the market performance of the fund. Then the remaining ones are all grouped under other investments. These are investments that do not come under fixed income or market-linked investments and can be grouped as other investments. These are also called alternative investments, for example, investing in real estate properties. Now let's look at all the 10 investment options and their tax implications one by one. First, let's look at fixed deposits. Fixed deposits, or popularly known as FDs, are one of the oldest and safest investment instruments provided by the banks and hence are the most popular investment type. The interest rates on fixed deposits are higher than the interest provided on savings account or current account balances. Fixed deposits are usually offered by banks and financial institutions. FDs offer guaranteed returns. They have a tenure ranging between 7 days and 10 years, or maybe even more. Fixed deposit interest rates range between 2% to 7%. So in the developed countries, the fixed deposit rates are on the lower side, around 2 to 3%, or probably even 1%. And in developing countries like India, the fixed deposit interest rates are may be as high as 6 or 7 or even 8%. Moreover, senior citizens are offered additional interest on their FD investments. The FD interest rates are higher than the savings account interest rate. The interest payments are made monthly, quarterly, half-yearly, or annually, or at a time of maturity as per the investment's choice. Investment in tax-saving FDs qualifies for tax benefits as well. Some tax-saving FDs allows you to make an investment to save tax under Section 80C of the Income Tax Act. The minimum tenure for a term deposit under tax saving scheme is 5 years. Moreover, the interest income is taxable as per the individual investor's income tax slab rates. Interest income from FDs also attract TDS, which is tax deducted at source. The next category of investment instruments we are going to look at are bonds. Bonds are fixed income instruments that offer a fixed rate of interest to the investors against the money invested. The investors lend money to the government and corporations and get regular income in the form of interest. Bond issuers are the borrowers who raise money publicly or privately for funding various projects. A bond is an instrument that includes information on the interest, due date, maturity date, and bond terms. Investors of bonds are paid the entire amount after the bond expires upon maturity. Investors can also sell the bond before maturity in the secondary market at higher prices and get profits. Government bonds are considered the safest. However, there are corporate bonds as well. Bonds are considered low-risk investments. However, there are certain risks attached to them as well. The most common risk is the default risk. Bond issuers can default on interest and principal repayment. However, investors can assess the risk in the bond before investing. They can do so by checking the credit rating of the bond. Bonds with higher credit rating are less likely to default on the payments than bonds with low credit rating. Bonds with AAA rating are considered the safest. Having bonds in one's portfolio helps investors diversify their investment risk. Another popular investment instruments are stocks. Investment in stocks is known as investment in equity. Buying stocks or shares would give investors a part of the ownership of that company. Investors invest in stocks with a motive to earn regular income in the form of dividends and also gain from capital appreciation. When the stock prices rise, investors can benefit from selling the shares. That is the time that everyone waits for, eagerly waits for. Returns from stocks are market linked and hence is considered the riskiest investment type. Share prices fluctuate based on market demand and supply and market sentiments. A bullish sentiment will lead to an unexpected rally of the market, while a bearish sentiment will lead to a drop in share prices. Investing in the share market should be done with a long-term investment horizon. In the short term, the market will fluctuate, which might lead to unexpected losses. Investors need to be patient while investing in equities. To invest in shares, investors need to have a demat and a trading account. A demat account will hold the shares while a trading account will facilitate the purchase and sale of shares. Short-term capital gains from stock investing below 1 year are taxable at 15%. At the same time, long-term capital gains are taxed at the rate of 10% if the gains are above 100,000 INR, which is 1 lakh INR per annum. Another investment instruments are mutual funds. Mutual funds are investment vehicles that pool money from investors to invest in assets like equity and debt. A mutual fund invests in shares, government bonds, corporate bonds, and other assets strategically. The fund house appoints a portfolio manager or fund manager who manages the mutual fund. Every mutual fund has an investment objective, and the fund's investments revolve around this. Mutual funds can be of several types based on the assets. For example, equity funds, debt funds, and hybrid funds are the three types of mutual funds based on the asset class. Similarly, funds can also be categorized based on their strategy, structure, and investment option. There are also mutual funds that offer tax benefits. These are called equity-linked savings schemes, commonly known as ELSS funds. Investment in these funds qualifies for tax deduction under 80C of the Income Tax Act. Returns from mutual funds are taxable as per the investment holding period. Short-term capital gains are subject to short-term capital gains tax. At the same time, the long-term capital gains are subject to long-term capital gains tax. Furthermore, tax rates vary for equity and debt mutual funds. Exchange-traded funds are also an investment option. The ETF is a passive investment option that usually replicates the underlying index. In other words, ETF's portfolio matches the composition of an index in the same proportion. An exchange-traded fund mimics and tracks the performance of the index. Hence, ETFs are not actively managed by a portfolio manager. Therefore, exchange-traded funds do not attempt to outperform their respective index. There are different types of ETFs. For example, equity ETFs, bond ETFs, currency ETFs, commodity ETFs, etc. Also, one can easily buy or sell them on the stock market. Now let's talk about gold. Gold has always been a go-to asset or investment, especially for Indians and also people all over the world. It is also an asset with great emotional and social value, not only for females, even for males too. Well, buying gold coins, bars, biscuits, and jewelry on auspicious days has been a tradition in India for ages now, and also among the NRI community all over the world. An asset with such sentimental value has also become popular in different forms. For example, gold bonds and gold ETFs are gaining popularity recently. Gold is used as a hedge to protect one's portfolio against potential market risk. Investing in gold doesn't provide any regular income in the form of dividends and interest. However, it is a relatively liquid asset and can offer inflation-beating returns. Now let's talk about real estate as an investment instrument, which is one of my personal favorites. Investing in real estate involves purchase, ownership, and management of the physical property. In other words, any investment in land, building, plant, property, etc. is considered as real estate investment. Investors' main aim of investing in real estate is to sell the asset at a higher price in the future or to generate regular income by way of rent. Real estate investing best suits investors with a long-term investment horizon. The prices of land and property do not fluctuate a lot in the short term. Hence, investors with a long-term goal should look at investing in real estate. Before investing in real estate, investors can be prudent. In fact, it's better they have to be prudent and do their research about the market prices. And it's also important to get the papers, the documents provided by the seller authenticated by legal experts. Capital gains tax is levied on the sale of real estate property, where exemptions can be claimed under various sections which result in no or low tax liability, and you will not have to pay any capital gains tax if you take benefit of those exemptions. I have another detailed video on this topic where the tax benefits have been explained in detail that can be claimed on the sale of real estate property, and you can find the link of that video in the description box below and towards the end of this video as well. Real estate investing also includes owning a part of the property with low investment. It is possible through REITs or real estate investment trusts. Real estate investment trust is an instrument with real estate properties as its underlying assets, and investors can buy a share of REIT to earn steady income in the form of dividends. These dividends are paid from the rental income from the underlying properties. It invests in properties like office spaces, warehouses, malls, etc., where investments can generate rental income. Through REITs, investors can earn regular income in the form of dividend. This dividend is paid from rental income the company earns. Now let's talk about cryptocurrencies as an investment option. The most popular ones are Bitcoins, Ethereum, etc. Cryptocurrency is a digital money that is secured by blockchain technology. Cryptocurrency investing can take many forms, ranging from buying cryptocurrency directly to investing in crypto funds and companies. You can buy cryptocurrency using a crypto exchange or through certain brokers or dealers. These are digital currencies which are not backed by real assets or tangible securities. They are traded between consenting parties and are tracked on digital ledgers. The advantages of cryptocurrencies include cheaper and faster money transfers and decentralized systems that do not collapse at a single point of failure. The disadvantages of cryptocurrencies include their high price volatility, high energy consumption for mining activities, and use in criminal activities. If you want to know more about the pros and cons of investing in cryptocurrencies, the risk involved and how you can mitigate those risks, then I have created a separate video which is titled as Cryptocurrencies for Beginners, and it is dedicated to the topic cryptocurrencies as an investment. You can find the link for that video in the description box below and towards the end of this video. Till now, we have covered 8 different types of investment options which are popular across the globe. Let's look into some of the important aspects that one must consider before investing in an asset. Investing isn't just about parking money in an instrument. Shortlisting the right asset is utmost important. Also, one should consider multiple aspects before investing in an asset. Some of the important things to keep in mind while investing are investment objective. Every asset has a unique investment objective. Therefore, it is very important to align one's investment objective with that of the assets they wish to invest. All investment types do not meet the requirements of all the investors. What may be a good investment option for one investor doesn't necessarily be the best for another. Hence, carefully aligning the financial plan and investment objective with the financial goal is important. For long-term goals such as a child's education, marriage, or retirement planning, one can invest in equities. While for short-term goals, one can consider investing in fixed deposits, money market instruments, and other fixed income investments. Second important point to keep in mind while investing is investment horizon. Different types of investment options are suitable for different investment horizons. For example, a fixed deposit may have a lock-in period of 1 to 5 years. Similarly, a PPF might have a lock-in period of 15 years, which it usually has. On the other hand, though mutual funds and equity investments do not have a lock-in period, it is advised to stay invested for at least 3 to 5 years. Therefore, depending on the investor's financial goal, it is wise to choose a suitable investment option with the right investment horizon. The third important point to keep in mind while investing is risk. Risk translates to volatility in an investment scheme. In other words, it is the measure of price fluctuations of an investment in response to the change in market dynamics. For example, shares or equity investments are subject to high price volatility, while fixed deposits and other government-backed schemes offer guaranteed returns. Not all investors have an understanding of risk. Therefore, it is important to invest in assets with the volatility that one can absorb. Fourth important thing to keep in mind while investing is returns. No investment offers the same returns. Few investments offer high returns, however, have significant risk associated with them as well. While some investments offer guaranteed returns, all investors invest with an expectation of generating significant returns. Therefore, it is vital to understand the asset's historical returns and performance. Historic returns do not guarantee future returns. However, it is always a good parameter to analyze the asset's performance across different market cycles. The next important thing to keep in mind while investing is cost and expenses. Every investment has certain cost or expense associated with it. For example, investing in shares attracts transaction cost. Mutual funds charge fund management cost, exit load, etc. Furthermore, few investments charge a penalty in case of premature withdrawals. Therefore, while shortlisting an investment, it is also important to consider the cost and expenses attached to them. It is always wise to invest in the scheme with low cost and expense. The next important thing to keep in mind while investing is liquidity. It is important to invest in assets that offer good liquidity. Liquidity is important to address any unforeseen events. For example, mutual fund investments and stock market investments are highly liquid. One can easily sell their holdings and convert to cash. On the other hand, real estate investments are not highly liquid. An investor may not be able to liquidate the asset as soon as they have a need for money. Therefore, it is important to hold assets with good liquidity in one's portfolio. The seventh important thing to keep in mind while investing is the lock-in period. Some investments have a lock-in period. Lock-in period is the minimum duration for which the investor has to hold the investment. For example, PPF has a 15-year lock-in period. Some FDs do have a lock-in period ranging from 6 months to 10 years. Investments with lock-in period usually does not allow premature or partial withdrawals, although there is an option for premature encashment of FDs, but there might be some loss of interest in that. However, in case of emergencies, one can withdraw with some penalty or loss of interest. Therefore, before investing, it is important to be aware that the funds would not be available for the duration of the lock-in period. Another important aspect to be kept in mind while investing is taxability. Returns from investments are taxable. For example, returns from mutual funds. are subject to tax on the basis of their holding period and the type of fund, while on the other hand, PPF investments are eligible for a tax deduction and the returns are completely tax free. Hence, it is essential to know the tax obligation on the returns from an investment. One can use an income tax calculator to estimate their tax liability. These were some of the important aspects that any investor must consider. In fact, all investors must consider if they want to improve the effectiveness of their investment selection. Now let's look at the key takeaways from this video. It is always good to commit to a timeline. You should give your money time to grow and compound. Determine your risk tolerance. Then pick the types of investments that match it. Learn the 5 key facts of stock picking, which are dividends, PE ratio, beta, EPS, and historical returns, which I will explain you shortly. The 80-20 rule, which is also known as the Pareto Principle, it is a helpful concept to keep in mind when starting a task that encompasses a vast amount of information, such as the topic, how to pick your investments. In many aspects of life and learning, 80% of the results come from 20% of the effort. This principle, named after economist Vilfredo Pareto, is often called the 80-20 rule. The next key takeaway is the magic of compounding. Another important reason to leave your investments untouched for several years is to take advantage of compounding. When people cite the snowball effect, they are talking about the power of compounding. When you start earning money on the money your investments have already earned, you are experiencing compound growth. This is why people who start the investing game earlier in life can vastly outperform the late starters. They get the benefit of compounding growth over a longer period of time. The next one is choose the right asset classes. Asset allocation means putting your investment capital into several types of investments, each representing a percentage of the whole. Allocating assets into different classes that are not highly correlated in their price action can be a highly effective way of diversifying risk. For example, you might put half your money in stocks and the other half in bonds. If you want to diversify your portfolio further, you might expand beyond those two classes and include real estate investment trusts, commodities, forex, or international stocks. To know the right allocation strategy for you, you need to understand your tolerance for risk. If temporary losses keep you awake at night, concentrate on lower risk options like bonds. If you can weather setbacks in the pursuit of aggressive long-term growth, then you can go for stocks. Neither is an all or nothing decision. Even the most cautious investor should mix in a few blue chip stocks or a stock index fund, knowing that those safe bonds will offset any losses. A blue chip stock is a huge company with an excellent reputation. These are typically large, well established, and financially sound companies with a long track record of successful operations. And even the most fearless investor should add some bonds to cushion a precipitous drop. The next one is the rewards of diversification. Choosing among various asset classes doesn't just manage risk. Greater rewards come from diversification. Nobel Prize winning economist Harry Markowitz referred to this reward as the only free lunch in finance. You will earn more if you diversify your portfolio. A blended approach always works better. Now let's look into traditional and alternative assets. Most financial professionals divide all investments broadly into two categories: traditional assets and alternative assets. Traditional assets include stocks, bonds, and cash. Cash is money in the bank, including savings account and certificates of deposit. Alternative assets are everything else, including commodities, real estate, foreign currency, art, collectibles, derivatives, venture capital, special insurance products, and private equity. Most individual investors will find that a combination of stocks and bonds plus a cash cushion is ideal. Everything else takes highly specialized knowledge. Now let's look into the balancing of stocks and bonds. If most investors can reach their goals with a combination of stocks and bonds, then the ultimate question is how much of each class should they pick? Let history be a guide. If a higher return is your goal and you can tolerate the higher risk, mostly stocks are the way to go. The fact is, the total return on stocks historically has been much higher than for all other asset classes. In the book Stocks for the Long Run, author Jeremy Siegel makes a powerful case for designing a portfolio consisting primarily of stocks. His rationale: over the 210 years, he said, he has examined stock returns. The real return on a broadly diversified portfolio of stocks had averaged 6.6% per year. Siegel says, a risk-averse investor may be uncomfortable with even short-term volatility and choose the relative safety of bonds, but the return will be lower. At the end of 2012, the yield on nominal bonds was about 2%, Siegel mentioned. He also mentioned that the only way that bonds could generate a 7.8% real return is if the consumer price index fell by nearly 6% per year over the next 30 years. Yet, a deflation of this magnitude has never been sustained by any country in the world history. Another important takeaway would be that cash is not an option. Cash is not an investment option at all. Whatever mix you choose, make sure that you make a good choice. Holding cash is not an option for investors because inflation erodes the real value of cash. Cash in point. At a rate of, let's say, 3% inflation per year, which is on a lower side, 1 lakh rupees or $100,000 will be worth just 40,000 in 30 years. Your age is as relevant as your personality. As you get closer to retirement, you should take fewer risks that could jeopardize your account balance just when you need it. Some people choose their stock bond balance by using the 100 rule. The idea is simple. Subtract your age from 100. The resulting number is the portion of the money that you place in stocks. The rest goes into bonds or other safer modes of investment. Therefore, a 40-year-old could invest 60% in stocks. 10 years later, the same person should not have more than 50% invested in stocks. Let's see how to pick stocks. Now that we can see that stocks offer higher long-term appreciation than bonds, let's look at the factors an investor needs to consider while evaluating stocks. In keeping with the Pareto Principle, the 80-20 rule, we will consider the 5 most important aspects. They are dividends, PE ratio, historical return, beta, and earnings per share. Let's consider these one by one. The first one is dividend. Dividends are a powerful way to boost your earnings. The frequency and amount of the dividend are subject to the company's discretion, and they are largely driven by the company's financial performance. More established companies typically pay dividends. Dividend payments are undoubtedly a sign of a healthy company. The second important aspect is the PE ratio. A price-earning ratio is the company's current share price compared to its earnings per share. A P/E ratio of 15, for example, tells us that investors are willing to pay $15 for every $1 of earnings the business earns over 1 year. The P/E ratio is the most commonly used measure of a stock's relative value. A high P/E ratio indicates that investors have greater expectations from a company. Those expectations may be unrealistic because investors are handling over more money in anticipation of future earnings, even though they cannot expect to know the future outcomes for the company. A low P/E ratio may indicate that a company is undervalued or that investors expect the company to face more difficult times ahead. The question arises, what is the ideal P/E ratio? The answer is that there is no perfect number. However, investors can use the average P/E ratio of other companies in the same industry to form a baseline. For example, the average P/E ratio in the healthcare products industry could be 161. The average in the auto and truck industry could just be 15. A stock's P/E ratio is easy to find on most financial reporting websites. Now let's look at the third important aspect, which is beta. Let's understand what beta is. This number indicates the volatility of a stock in comparison to the market as a whole. A security with a beta of 1 will exhibit volatility that's identical to that of the market. Any stock with a beta of below 1 is theoretically less volatile than the market. A stock with a beta of above 1 is theoretically more volatile than the market. For example, a security with a beta of 1.3 is 30% more volatile than the market. If the market index rises 5%, a stock with a beta of 1.3 can be expected to rise by 8%. Beta is a good measurement to use if you want to own stocks but also want to mitigate the effect of market swings. The fourth important aspect is earnings per share. EPS is a dollar figure, or you can call it a monetary figure, representing the portion of a company's earnings after taxes and preferred stock dividends that is allocated to each share of common stock. As the name suggests, earnings per share is the amount of earning that the investor will earn for one share. Investors can use this number to gauge how well a company can deliver value to shareholders. A higher EPS begets higher share prices. The number is particularly useful in comparison to a company's earnings estimates. If a company regularly fails to deliver on earnings forecasts, an investor may want to consider purchasing the stock. The calculation is simple. If a company has a net income of, let's say, $100 and pays $10 in dividends, then the remaining income of $90 is divided by the number of shares outstanding. If there are 10 shares outstanding, the EPS is $9 per share, which is income divided by the number of shares outstanding. Now let's come to the fifth important aspect, which is historical returns. Investors often get interested in a stock after reading headlines about its phenomenal performance. Just remember that's yesterday's news. Or, as the investing brochures always phrase it, past performance is not a predictor of future returns. Sound investing decisions should consider context. A look at the trend in prices over the previous 52 weeks, at the least, is necessary to get a sense of where a stock's price may go next. Another important aspect is to do a technical and fundamental analysis. You can pick investments for your portfolio through a process of technical analysis or fundamental analysis. Let's look at what these terms mean, how they differ, and which one is best for the average investor. Technical analysts comb through enormous volumes of data in an effort to forecast the direction of stock prices. The data consists primarily of past pricing information and trading volume. Fundamental analysis fits the needs of most investors and has the benefit of making good sense in the world, in the real world, I would say. Technical analysts are not interested in monetary policy or broad economic developments. They believe prices follow a pattern, and if they can decipher the pattern, they can capitalize on it with well-timed trades. In recent decades, technology has enabled more investors to practice this style of investing because the tools and the data are more accessible than ever. Fundamental analysts consider the intrinsic value of a stock. They look at the prospects of the industry, the quality of the company management, the company's revenues, and its profit margin. Many of the concepts discussed throughout this piece are common in the fundamental analyst's world. Technical analysis is best suited to someone who has the time and comfort level with data to put limitless numbers to use. Otherwise, fundamental analysis will fit the needs of most investors, and it has the benefit of making good sense in the real world. The last but not the least is to manage costs. Aim to keep costs low. Brokerage fees and mutual fund expense ratios pull money from your portfolio. Those expenses cost you today and in the future. For example, over a period of 20 years, annual fee of 0.50% on a $100,000 investment will reduce the portfolio's value by $10,000. Over the same period, a 1% fee will reduce the same portfolio by $30,000. Fee creates opportunity costs by forcing you to miss the benefits of compounding. The trend is with you. Many mutual fund companies and online brokers are lowering their fee in order to compete for clients. Take advantage of the trend and shop around for the lowest cost. Now let's quickly look at the two remaining investment options that are PPF and NPS. PPF stands for the Public Provident Fund, which is one of the post office savings schemes launched by the National Saving Institute, and this one is specific to India. That's why I kept it towards the end. However, some private and nationalized banks are authorized to accept PPF investments. Returns from the scheme are guaranteed as the Government of India backs it, hence are considered as low-risk investments. Furthermore, the PPF investments come with a 15 years lock-in period. Also, in case the investor wishes to extend the scheme, they can do so in blocks of 5 years. Furthermore, for the purpose of tax savings, one can invest in PPF. The PPF interest rates are announced every quarter. The annual current rate is around 7.10%. Also, the interest payments are made every year on the 31st of March. However, the interest is calculated monthly on the minimum PPF balance between the 5th and 30th of each month. Investments up to INR 1,50,000 per annum qualifies for tax exemption under Section 80C of the Income Tax Act. The next one is, or I would say the last one is National Pension Scheme, which is NPS. NPS is a scheme suitable for retirement. Investors who wish for regular income post their retirement and also save tax can invest in the NPS. The central government backs them and hence are considered as low risk investments. An investor can invest during the period of their employment at regular intervals. The scheme allows the investor to withdraw a percentage of the accumulated amount post-retirement. Also, the investor receives the remaining amount monthly as a pension post-retirement. NPS has two types of accounts, namely NPS Tier 1 account and NPS Tier 2 account. Tier 1 account is a default account, while Tier 2 account is a voluntary account. NPS investments up to INR 1,50,000 qualify for tax benefits under Section 80C of the Income Tax Act. Furthermore, an additional INR 50,000 is eligible for tax deduction under Section 80 CCD of the Income Tax Act. So friends, now it's time to wrap up this video, and I hope you all will benefit with various aspects of different types of investments that were covered in this video. I hope you like the contents of this video, and I request you all to please do subscribe right now. You just need to log in with your email ID on YouTube, if not logged in yet, to subscribe. That's it. It's totally free for all. So please do it right now. Subscribe, like, and share it with your family and friends. Do it. Do share it in the WhatsApp groups in your phone as well. Also, post your comments and give your valuable feedback for this video in the comments section on YouTube. You can watch more videos on financial planning and investments related to investment in cryptocurrencies and how to claim tax benefits on sale of house property, for which you can find the link at the end of this video and also in the description box below. Thank you and bye-bye.